Hey folks, welcome back to this edition of Ben's Bits. Last week we covered a further refinement of the approach we take here concerning our investment portfolio. And we spent a little time discussing why we approach potential acquisitions the way we do. And we also used a great illustration to drive that point home. So if you've not watched that particular video and you'd like further enlightening, but if you want a clearer understanding, be sure to check out that video and let us know your thoughts. And if you have a counter proposal, we're always challenging our approach as well to make sure we're not pigeonholing ourselves and walking the walk and talking the walk, so on and so forth. So we adhere to the principle of investing for what matters most. And for us right now, the priority is capital building and wealth acceleration for a variety of reasons. But most importantly, it's the unknown future. There are countless articles out there specifically dealing with retirement needs and the costs associated with that time frame of life. And we want to build up that capital to be positively sure that we can outlive the costs that are associated with retirement. That said, this week we wanted to address a talking point that we had with an investor recently, and it was really great. A case study, if you will, about the eviction moratorium and the possibility that that can is being kicked down the road indefinitely. And the main reason we're discussing it is because there is a real fear about landlords having to float these costs to the point that, well, quite frankly, to a point where they just run out of resources and they come to the point where they have the decision to either cut their losses or continue to fight and hold on to their investment. And unfortunately, there are a lot of landlords who are finding themselves in a position of losing their assets, and they're caught in having to make that decision. And it's not an easy decision to make for sure, but this particular investor was making the decision to either cut losses or continuing to fight for a few months longer. And when we were speaking to him, we mentioned it's one of those rock and a hard place decisions, and one that's far reaching, because one thing that has to be taken into account is if you're able to get out from underneath an asset and avoid the current market issues, if you sell that asset at a loss, you most likely are going to get hit with a 1099 from Uncle Sam. So if you remember back to the short sale frenzy, people would sell an asset and at a loss and just to get out from underwater, and then they'd receive that 1099 of the difference and then have to pay on that as if they actually received actual income. That's why landlords find themselves in a very precarious situation and really have to think through the ramifications of their decisions. That's why we've been working with investors to help them avoid being in the situation of countless nights of sleep, worry, sleep deprivation, that is, because it's one thing to cut your losses, but it's another thing entirely to have salt poured on that wound to boot. So that's it for this edition of Ben's Bits. And as always, thanks for watching, and we'll see you next time.